So in this video, I'm going to be talking about deep value investing. And specifically, we're going to take an in-depth look into how deep value investing works. We're going to look at some real data behind it to see if it's actually something that maybe investors out there should be willing to try out at some point. And I thought that this video would be a nice follow-up to the previous video that I did on this channel where I was looking at growth investing. And basically what I tried to do was debunk the myth that if you want to invest in high quality companies that are growing really fast, and earn, very substantial returns, that you have to be willing to invest in expensively priced companies, which, as I showed in that video, was actually not the case at all. So deep value investing is basically the polar opposite of that, where you're looking at the most disgusted, the most hated, and the most unwanted companies out there and trying to look at them objectively to see if there's actually potentially some hidden value to these companies. And for this video, we're going to focus on the most popular deep value investing strategy, which is called net investing. So net investing, it was created by Benjamin Graham, and the technical definition of it is you basically, for a given company, you take all current assets that they have and you subtract all liabilities, so both non-current and current liabilities. And if that amount is greater than the company's market cap, then it's considered a net stock. And with these companies, in theory, what you could do is you could buy the entire company for whatever the current market cap is. You could sell all of the assets that it owns, convert those assets into cash, use that cash to pay off all outstanding liabilities the company has, and then your profit is the difference between the market cap that you paid to acquire it versus the so-called liquidation value. And in theory, what you're doing with this strategy is it's this asymmetric risk reward profile, because even in the worst possible case scenario where the company has a forced liquidation event, for example, bankruptcy, you'll still be making a profit with that investment. So once you hear that, you may be wondering, well, why do these companies even exist in the first place? And you probably have a lot of questions about how this strategy works, which is kind of why I wanted to break it down in this video. And what I also wanted to mention, just to kind of clear up the technical definition a little bit, is why we only include current assets as opposed to non-current assets. So non-current assets could be things like goodwill, intangibles, fixed assets like land, property, equipment that the company owns. So these are excluded from this calculation. And the reason is because oftentimes when a company is forced to liquidate, these assets basically have no value, right? If you're thinking about a liquidation event for a company, that's probably because the assets the company owns aren't producing very much cash, which means assets that aren't producing very much cash are probably going to be hard to sell to begin with. So really the only assets they have that have real value will be the actual cash that they own, the receivables that they have, which they can then sell to a receivables financing company, maybe some outstanding inventory, and then maybe some other current assets sprinkled in there. But really, what we're trying to get at is a very conservative estimation of the company's liquidation value so that we have that so called margin of safety. So that's really the theoretical side of deep value investing. Now let's look at some actual data to see how well this strategy actually works. And for this, we're going to use some backtests that I created in Tickernomics. And if you're new to my channel, Tickernomics.com is a website that I created to help retail investors get better at analyzing companies. And one of the key features it has is one of these things that we've called scripting. And one of the uses of scripting is we can create backtests to see how well certain value investing strategies have performed historically, which is good because I think looking at actual data behind strategies, it can help clarify some misconceptions that maybe people have about the way things work in the world of investing. So I think it's a really useful feature. And all the scripts that I showcase throughout this video can be accessed on my site. And it's currently a free site. So I'll leave a link in the description of this video, and you can go to public scripts here and you can search for the names of any scripts that I create. For example, we'll start by looking at a 5-year backtest of the net stock strategy. So I'll save this to my scripts. And then once it's over here, we can actually run the script itself. So I'll click run with this script here, and it's going to take a few seconds because it basically goes through every company, which is tens of thousands of companies, to see if they meet this net criteria. But we can see that it's done now, and what it does is it generates a table. So we click Insight Tables here, and here is our list of our backtest. And so this column here, it has the name of the company and then a slash, and then after the slash is the industry that it's in, because I want to make an important point about the industries that we're going to see quite a lot of these companies being in, because it reveals a lot about this strategy. And what we're going to do is make some revisions to the net backtest to see how well it would have performed under certain revisions. But usually, I like to just look at the data first, and sometimes I will do a summary in Excel of the overall results. But for this, I'm not going to do that because I think a lot of the results are pretty obvious if we just look at the list first. And there is quite a lot of companies that are on this list. One of the most obvious things that we note about them is their market cap. So this is their market cap here, and if we sort this, we can see there's a lot of very, very small, very illiquid companies that meet this list. And this is really one of the main faults of this strategy, since really the underlying logic, because we can see, I mean, the market cap for some of these companies is, this is in millions here. So this is literally a 1 million market cap company as of 5 years ago. And then this column here is basically their annualized return over the past 5 years. So some of these companies, it looks like they've had okay returns, but there is a lot of very small companies. Like we're past halfway through the list and we're just now getting into companies that are in the just above 100 million in market cap. And I could sort by the largest market cap companies. And we can see there's a few eight-figure companies in here, so they're not all extremely tiny. But again, there's still some, if you're looking at the companies in this list, there's still some issues in the list. So I'll talk about that now. But one of the main faults of having these very illiquid companies show up in the list is it's kind of assuming that we could invest in these companies is a little detached from reality. Because if we were to try to implement the net investing method in real life, remember, this assumes that you're buying the entire company. So you'd have to buy every single share of stock from every stockholder of the company. And some stockholders may not be willing to sell us their shares unless we offer them a very high price, which may push the acquisition price above that liquidation value and make the transaction overall unprofitable. And I'm not saying we would actually end up doing this, like actually end up buying the entire companies, but you have to remember the key logic behind net investing is that there is that assumption that you could do that if you had enough money to do it. And it provides that margin of safety. But if in reality, if you did try to do that, you wouldn't be able to, then it kind of, makes the strategy not really worth it. Another strategy that we see is, the variance of the returns, which by the way is this column here, the 5-year analyzed returns, is very significant. There are some companies that have done pretty well, some companies that would have outperformed the market, but there is a lot of companies that did not do well at all. For example, we could sort the list here, and this is negative 61% for the worst performing company, and that's every year. So that means for 5 years holding this company, you're losing 60% of your investment every year. And there's quite a lot of these companies. For example, we scroll down, we're past halfway through the list, and we're just now getting into companies that were in the green, right? And this isn't even outperforming the market. This is just companies that made it into the green. But there are some exceptions. There are some companies here that even had, extremely strong returns, above 100%. That's one issue with the list. Another issue, if we talk about the actual types of companies we see, is we see a lot of asset management companies. And I think the reason asset management may be overrepresented in net stocks is because they are, in effect, holding companies, really. A lot of these companies are holding companies with essentially no liabilities, and all of their assets are just investments, right? And holding companies, just in general, they tend to trade at a discount to their net current asset value for several reasons, but one of them is investors in the holding company may value the underlying holdings differently. So they may not actually agree with the holding company's valuation. And this is especially true if you're talking about, that holding company having investments in non-public companies, because those valuations can be very subjective. And also their ownership structures may be too complex for investors to properly assess and may just be very opaque overall. And then you also have to consider tax consequences, right? Like when they were to eventually sell their investments, they would have to pay taxes on them. So they may get discounted for that. And then we also see a lot of companies that are related to real estate. So there's a lot of companies that are kind of, in construction management or, real estate finance, that type of thing. For example, we can see residential construction here. And if we were to scroll the list, we'd see a lot of companies that are in this residential construction area, or even some REITs that are showing up in the mortgage REIT area. So the reason you see a lot of these companies is because, again, it has to do with the types of assets, right? A lot of these companies, what they do is they buy land, they list that land as inventory on their balance sheet, and that inventory is a current asset, right? And they have the hope of developing it and then selling it later on for a profit. But if the market value of those assets declines significantly, which can happen, it can result in the company's market cap falling way below its net current asset value. And especially with real estate finance businesses, they're also exposed to credit risks associated with their lending activities. And that's also why you see quite a lot of banks showing up here as well. Pretty much any company that is a net stock, if that company is exposed to any sort of credit losses, that's kind of a red flag because it could mean that something happened, since the last time they reported their results, and maybe they had a large amount of losses, and they're not really a net stock. They're just showing up on the list because they haven't reported quarterly results and showed, some losses that they've had since then. And just to point this out, I'll give a real life example of one company that showed up on this list. So it was a company called Beazer Homes. And what happened with this company, if I'll go to their SEC filings here, and it's basically exactly what I talked about. For example, if I were to go to their 10Q here, and we just go straight to the balance sheet, which again, this is a balance sheet type valuation that we're doing. So here's their assets. Their largest asset is this here, and that is owned inventory. So that's just inventory of homes they have, and especially if this company operates in a very specific region, and that something happens to that region where they own all that inventory, then that can lead to pretty large losses. And really, they're not a net stock because the market is misrepresenting them. It's really just because something actually happened to them and they deserve to be on the list. And then the last type of company that we see a lot of appearing, if I go back to the list here, is we're going to see various biotech stocks. So we can see, for example, one here. And if we were to scroll through the list, we'd probably see several others, even diagnostics and research, another biotech here. And I've said this before, but biotechs, they're really their own unique area of the market that plays by their own rules. They may be included in this list just because of some very short-term cash burn that they have, where their actual current assets are less than what they were reported. So similar to what I just talked about. And these companies, they have to spend a lot of money on R&D, on clinical trials, on regulatory processes. So basically, what I want to do now that we've looked at the list a little bit is I want to make a revised list where we take away some of these industries and these sectors that are on this list probably for a legitimate reason, and we kind of isolate the unique industries that are showing up. So to account for this, what I did was I created a revised script. So again, this is a public script that you can access. If I go to my scripts, there's this one here. It's called Net Stocks 5-Year Backtest Revised. So I'll run this. It's this one here. And what this does is it's the exact same list, except it removes financial services businesses. It removes biotechs, anything related to real estate like REITs or real estate finance. And then any companies with a market cap below 100 million as well to account for that liquidity issue that I mentioned before. So what we're looking at here is the 5-year back test with those revisions that I made. And now we can see the list is significantly less than the other one. In fact, we only have about 10 companies that made this list. And we can see if we look at the actual results, our results are a lot better. There's only 2 companies that had negative returns over the past 5 years. And in fact, our average returns on this hypothetical portfolio of net stocks are just under 10%. And we can see within that, there's even some very strong performers, some companies that had 20+% annualized returns for 5 years, which is obviously quite good. So by removing all that garbage from before, we now seem to have developed this formula that gives us a short list of 10 or so companies, which a lot of them will end up doing actually pretty well, which I think is pretty valuable to have. Now, I was also curious to see, because this is a 5-year backtest, how it would perform over a different time period. Because some people may make the argument that for these types of companies and this type of investing strategy, 5 years is a bit too long. Really, you should just wait until, the quote unquote true value is realized, and then you would sell. That would be a more, accurate depiction of the strategy. But To that, I would make the counterpoint that it's also kind of unreasonable to assume that you could have timed the market perfectly to sell the company when their true value is realized. But just to account for that, let's look at a 2-year backtest. So I'll look at this script here, which does exactly that. It's basically the exact same script, but it's 2 years instead of 5 years. So I'll run this and it'll take a few seconds. And then now that it's created, we can go here, and it's a pretty similar list where it only has about 10 to 12 companies, and we can see our returns have appeared here, but there are some notable differences. It's similar in a lot of ways, but then different in some ways. One way it's different is the returns are quite different. For example, we can see there's a few more companies that had negative returns, and the companies that did have negative returns had very negative returns. For example, there's even this company here called Lucira Health Incorporated. It's a medical devices company based in the US that had negative 92% return for both years. So that means this investment basically went to zero. And I think, doing this was a pretty important step to do because it reveals this type of data. And you can see that it's pretty different than the 5-year back test that we did. And a bit of background on this company, Lucira Health, because I was curious to know, what happened with this company. Would it be something that we could have conceivably avoided if we were trying to follow this investing strategy? And basically, what we can learn about the company, I'll actually look them up here in Tickernomics and just show you a quick description of this company so we know what they do. So Lucira Health, they're a medical technology company, and they actually make COVID-19 testing kits. It's this all-in-one testing kit. And then this article that I had here kind of explains what happened with them. So eventually, they ended up filing for bankruptcy in early 2023, and they got bought. Their assets got bought by Pfizer. So I feel like with this company, it would have been a pretty obvious one to avoid because basically, if you had just asked yourself the question, is this company selling a product that is probably going to be obsolete in 2 to 3 years? You would have answered yes to that and you would have avoided this company because they really only had one product. It was just these testing kits. So once these testing kits aren't needed anymore, then they really have nothing to sell. So I think this would have been a pretty obvious one to avoid. And it kind of just highlights, how you can, if you're following this strategy, what you can do is just a cursory view of these companies can probably reveal certain things that will lead you to avoid them. And your goal should be trying to identify with these companies, is the reason they're a net stock because there's an actual something wrong with their business, something that they can't fix, and something that, basically has no expectation of things being turned around? Or are they a net stock because there's just some unfound fear about the company? Maybe investors are just worried about some future event and they're just overestimating how bad that's actually going to be for the company. So I think net investing is a very interesting strategy that has some real potential. So before I conclude this video, what I want to do is make a commitment to you guys, which is that sometime over the next year, I will invest in a company that is a net stock and give this whole investing strategy a try. And the reason I'm doing this is because, for one, from what I've learned studying this strategy, I think I can do it successfully. And I also think it'll be a fun little experiment to show you guys in real time how I go about finding a company, explaining why I bought it, and then we can together see how that investment turns out. And I'll make videos, documenting this whole journey so you guys can follow along. And I'm not going to bet the house on this company. It's going to be a small position. But yeah, that's my commitment to you guys. So look out for that in the future. So in conclusion, I think deep value investing, despite the way it's advertised as this low risk, high return strategy, is in reality a pretty high risk strategy. But I think the fact that it requires this human element of actually learning about each company and being able to weed out why it's a net stock for qualitative reasons, like we saw, it makes it a very interesting strategy because if you are able to differentiate between the deep value stocks that deserve to be there versus the ones that don't, then you can have some pretty high returns from doing that. And what I've done here is kind of developed a list of 5 questions that you should probably ask yourself if you're following this strategy. So one is kind of based off of the lessons we learned from the Lucira Health one, which is the company selling something that is going to become obsolete? Is there any reason to believe the company's cash burn rate in the next few months is so high that really the only reason it's a net stock is just because they haven't reported their quarterly results yet, which is going to reveal that their net current assets have gone down quite a lot? Also, does the company have credit losses, right? Because then maybe their receivables or just their assets in general could be overstated if there was some event that triggered a lot of credit losses. And then is the company's customer base extremely concentrated in just a few key customers? Because if they lost one of those customers, or there's the risk of them losing the customers, or if there's some lawsuit with the customer, then that could be the reason why they're there. And then is the company's current assets largely made up of one item that's difficult to sell? For example, the land inventory would be harder to sell versus the current assets just being things like cash and receivables, which they can probably sell. So those are questions that I would ask. And then one slight revision that I would also make is to include companies where their market cap is basically just slightly higher than their net current asset value, because there's probably a lot of other people out there that have these screeners they run to look at net stocks. So there might be some companies that aren't quite included in net stocks yet, but maybe they should be included just because they're almost there and just not quite there. And maybe the people that have those screeners they're looking at don't see these companies just yet, but they will in the future if they keep declining. So anyways, I'll leave the video at that. Comment your experiences. If you ever tried anything related to deep value investing, I'd be interested in hearing about that. And if you did like this video, then make sure you check out the last video I did where I looked at growth investing, which I will put up on screen now.